Hello, everyone. Thank you so much for joining us here today. Our NewFi team is so excited to talk to you about stackable income. We are going to get started here in just a moment, and this entire presentation is being recorded. It will be sent to you along with the presentation slide deck and any resources that we address during this call within 24 hours of this call. So you'll get everything sent to you at the end. And we'd love this to be a conversation, two-way street here. So if you have any questions, we want to hear from you in the Q&A box. It won't be in your chat box, which you might normally use, but in that Q&A box, you can add in your questions. If there's any question we don't get to, somebody will get you an answer today. So we'll make sure, even if we miss your question on this call, that you get an answer. So feel free to leave any scenarios, any questions, and we'll go through them during this slideshow. So excited to introduce our host today. Our first one, Kendra, you want to tell us a little bit about yourself?
Yes, absolutely. Hi, everyone. My name is Kendra Eakins. I'm a producing sales manager here at NewFi. I've been here for about 3.5 years, was a loan officer before I became an AE. So many years in the industry and very much view this as a partnership. We're here to help you any way that we can. And
Michelle, you want to introduce yourself as
Oh,
well?
sure, sure. Michelle McBride. I am an account executive here in Texas. Work for Kendra. Been an account executive. I've been in the business for a very, very long time as well, and looking forward to today. Go ahead.
awesome. Thank you, guys.
Mm.
So NewFi, I just like to start off by saying our executive team has been in the industry for a very long time. And some of the biggest benefits that come along with that is not only do we make sure that we're staying very competitive on price, very big on technology to try to make things as easy as possible for you guys. But in my opinion, just as importantly, we're very big on common sense underwriting. And a big part of that is our executive and our underwriting team are constantly coming up with new products or improvements to our existing programs to help you guys help more borrowers. All right, so stackable income, this is something that we've had for a while in some capacity or another, but we're starting to see a lot more of a need and a response for it. So today we just wanted to kind of share some different ways that you guys are able to stack income to be able to qualify more borrowers and also be able to qualify them for more. Okay, so this is just an example of some of the income types that we are able to stack. As you guys can see, we can do IRA, asset depletion, 1099, W-2 to 1099, which is one of my favorites. We have the bank statement options as well as the CPA options, so gross receipts and P&Ls. And then we can also do flipper income on bank statement as well. All right, so this is just an idea for you guys of what we offer. So as you can see, we can go up to 3.5 in most cases on loan amount. We can go up to 90 LTV on primary purchases and then 85 LTV on rate and terms. As you can see, we can go as low as 620 in a lot of cases on our credit scores, and typically up to 55 on the DTI. Cash out amount, we can typically go up to 3 million. And then we also have several different term options to fit all borrowers. One thing that's really, really nice is we also have the temporary 2-1 buy downs available. So, and I'm starting to see these come back through and grow again in popularity. So just like you guys saw before a couple of years ago on the agency side on primary residences, the temporary 2-1 buy downs, you are also able to offer those through us on all of our non-QM offerings on primary residences. In addition, we're also very friendly for non-occupying co-borrowers and also first-time home buyers. Okay, so we wanted to start off with the IRA as income. This is truly one of my favorites, and I'm doing quite a few of these a month, and they are definitely gaining momentum. So, this is an option that you can either stack with any of the other document income types that we offer, but you can also use it by itself. So, obviously, with this, we don't need any tax returns. We just want to see 3 months of their most recent statements for their IRA account or most recent quarterly if they come out quarterly. And the really nice thing with the IRA's income is this can be done not only without requiring distributions, but also regardless of their age. So you can literally have a borrower who is 20 years old that has an IRA account, and we're able to use that as qualifying income for the borrower. So basically, the way this works, like I mentioned, we'll want to see the last 3 months of either monthly or the quarterly statement. Obviously, we want to verify that the account is theirs. If they are under 59 and a half, we'll use 90%. If they're 59 and a half and above, we'll use 100%. And then whatever that total is, we divide that by 36 months. And that's their qualifying monthly income for IRA. And this is just an example that we wanted to give you guys. So as you can see, this is a borrower, 47 years old, has an IRA with an $800,000 balance. Since they're under 59 and a half, you would do the 90% over 36 months. So this borrower just got an additional $20,000 in monthly qualifying income without having to do anything with their IRA account.
Hey, Kendra, I have a question.
Yes.
What is the maximum LTV on using the IRA?
Fantastic question. So this falls under our Sequoia 1-year full doc. And that particular program, we can go up to 90 LTV on a primary with a score of 720 or above.
Awesome. And does this work with other retirement accounts or is this just for IRAs?
So this particular calculation is just for IRA accounts, but we'll definitely go into some other options for you guys in this webinar as well.
And when you're pricing the IRA online, do you choose a full doc option?
Very good question. So yes, you'll use the 1-year full doc option when you're pricing it out.
Awesome.
Perfect. All right, so this is another example that we wanted to include. This is, as you can see, the borrower is 60 years old, so they're obviously over 59 and a half. So in this example, we're able to use 100% because they're over retirement age. So for this borrower, they had a combined IRA balance of 300,000. So that gave them 8333 in additional monthly qualifying income.
And Kendra, when you're calculating the income for a purchase, do you have to take out the down payment and reserves before you calculate the income?
So that really depends. It's more case by case basis. So if they are planning on liquidating their IRA account to use towards cash to close, then yes, we would need to back that out. But typically, what we're seeing is they're using other accounts, brokerage, checking, savings, 401k to cover cash to close and reserves, and they're leaving the IRA alone.
And on your self-employed programs, are you okay if a self-employed person goes from Schedule C to an S corp and then they go back to the Schedule C. Uh, in this case, it's a loan officer.
Okay, so that is a really good question. We would want to see a little bit more detail to give you an 100% answer. However, typically, as long as obviously a Schedule C is a sole proprietor, as long as it stays a sole proprietor, that's usually something that our underwriting team is willing to entertain.
And does this work for inherited IRAs?
That is a very good question. Yes, it does. We would need to see the documentation for the inheritance to verify that it is truly the borrower's money, but yes.
Awesome.
Yep. Good question. All right. And that was the perfect segue into what types of IRAs we can use. So, as you guys can see, we can use the Roth, traditional, the SEP IRAs, simple rollover IRAs. So, one thing that's really nice about this is if you have a borrower who has a 401k with a prior employer, we treat that as an IRA because it's not their current employer. And then, as we just discussed, we can also do inherited and also custodial IRAs. So, like we just talked about with the inherited and the custodial, main thing is we just want to see documentation to verify that the money is truly now the borrower's money. All right, so we have had a lot of our brokers, I call them wholesale partners because, like I said, I very much view this as a partnership. We've had a lot of our wholesale partners tell us that the financial planners and CPAs that they've spoken with about these absolutely love these programs because, like I mentioned, we don't require any distributions to be set up. So therefore, the borrowers don't have any tax ramifications that, no tax penalties. And I also like to point out all of us in the industry likely have tax preparers, financial advisors. These are a really good referral source for borrowers that have the IRA or different asset accounts because obviously they're working with people that are typically higher net worth. So definitely recommend, especially since it's tax time right now, that you let your tax preparer know what you do, what options you can offer in regards to this, so that way they're able to share your information with their other clients as well.
And Kendra, in general, what is our EPO policy?
That is a very good question. So typically our EPO policy is 7 months.
Thank you so much.
Mhm. All right. So, in addition to the IRA's income, we also have our asset depletion program. So, with this, as you guys can see, we can use 100% of liquid, so checking, savings, money market accounts, 80% of stocks and bonds, and then retirement funds, either 70 or 80%, depending on their age. And typically with this one, we're seeing 401ks of existing employers being used as retirement funds since we can do the IRA option a little bit differently. And then we can also, just recently, this was rolled out, that we can use 50% of crypto and ETF funds, and then 25% of Bitcoin and Ethereum in Coinbase. So those are the breakdowns of the percentages that we can use. With this particular program, you will tally up all of their total assets. You'll do the haircuts. You'll back out any cash to close that they're pulling from these accounts. And then the really nice thing that's different about us is we do this over 60 months instead of 84 or 120. So obviously that gives the borrower a lot more qualifying income. And true to the theme of this particular webinar, you can stack these with all of the different income types, and we'll go into some of our other doc type offerings. But you can either use asset depletion by itself, or you can combine it with full doc, bank statement, 1099, pretty much all of the other options that we offer.
So on the asset depletion, did you say that you can use 401ks?
Yes, we can use 401ks.
And on that, if it's divided by 60 months, wasn't the IRA divided by less?
Yes, very good catch. So the IRA is done at 90% if they're under retirement age over 36 months. And then a 401k would be done at, say, 70% if they're under 59 and a half over 60 months. And that's something that either myself or your account manager or account executive can help you guys with. You are always more than welcome to give us a call or send us the asset statements, and we'll help you guys do a quick calculation so that you know what the qualifying income is.
Is asset depletion price better than the IRA program?
That
What
is
is
a very
the
good question, and it's typically, from what I've seen, the same.
And if someone has 800,000 in crypto, you can use 400,000 to determine income?
Correct.
And then does it matter, going back to the IRA, if it's a traditional or Roth?
It does not matter either way, it's their individual retirement account. And just for anybody who doesn't know, the only difference between a traditional and a Roth account on IRA or 401k is that a traditional is pre-tax funds and a Roth is post-tax funds. But either way, it's still their money, it's treated the same way.
When we're doing an IRA or asset depletion loan, are these non-QM loans in the pricer or are they conventional?
So they are non-QM. However, if you select conventional, the pricing will still pull up for you.
Great.
Mhm. Perfect. All right. And now Michelle is going to take over for you guys. Thank you so much.
All right, next is 1099 income. And as a reminder, any of these can stand on their own as well, just as a reminder, but you can also stack with 1099 income. And this is huge for like contractors, gig workers, commission earners. We would need 1 or 2 years of 1099 plus their year-to-date income verified. And we apply an expense factor of 10%. That's the standard expense factor, but you can go lower with a CPA letter. To point out the default, I guess, if you will, for loan officers when they're self-employed is often to send bank statements in. But if they have a 1099, you can, as long as, they are, this isn't really for someone who has employees. This is for a contractor or a gig worker. But if they have that 1099 and they fall into this category, out of the gate, you get a lower expense factor. So that's always a good question to ask if they have a 1099. And the calculation is pretty straightforward. It's gross income minus the expense factor divided by 12. We'll also verify their activity, their income activity with recent bank statements. So anyhow, option is especially helpful for borrowers who write off aggressively on their taxes and don't qualify conventionally.
And do you have a HELOC or second mortgage using 1099?
We do not.
And just to be clear, a 401k account is an employer-sponsored active plan, whereas the IRAs are not, correct? Could we consider a previously employer-sponsored 401k and IRA if they no longer work for that company?
Correct. And yes, we can.
Awesome.
All right, this one is very popular with us. It is W-2 to 1099. And especially post-pandemic, this is I've seen more and more borrowers who were previously W-2 and now they are in 1099 contract roles. And the big thing here is that they have they don't incur any expenses as an employee. So everything is all expenses are employer paid. They provide labor only, basically. So we would need a letter from the employer or their employment contract. That's the first thing I would ask for when you're talking to someone that's recently switched from 1099. They say they don't have any expenses. Ask for their employment contract, and this would, in most cases, tell us how the expenses work. And in which case, we can use the full payout of the 1099 income. I don't have to have a minimum time on the job, no minimum income history. And we would consider this 1 year full doc and do not require tax returns. So that's a big one. No time as a 1099 employee. You couldn't do that somewhere else, right? You'd have to, conventionally you'd have to have 2 years. All
So,
right.
how about a traveling nurse that went from W-2 to 1099? Would they have expenses? Would this work for them?
It, it depends on how their contract is structured. It's one of the things about doing non-QM, I think, is stay engaged with your account executive. So if you're not sure, you want to give your account executive a call, and they'll help you through it. But I have seen, yeah, the medical professional, this is a big one, the W-2 to 1099, and probably, but we need to see the contract first.
And if the borrowers are physicians that went from W-2 to 1099, but at different organizations, does that still work for this program?
As long as they don't have any expenses.
Great. And
And yes, I've seen this work for in the medical, that's a good example of it. But again, we'd want to see their contract.
how is the income calculated if the borrower only recently switched to the 1099?
We use 100% of the payout. So um, if they make $100,000 a year, you get 100 divided by 12. Does it make sense?
Mhm.
Okay.
So if they do have expenses as a 1099, do I have to do a full doc with taxes?
Nope, that would be the slide before this, where we can do a 10% expense factor as a 1099 employee.
And then when you say no minimum history, if they've only been 1099 1 month, do you just use their income for that 1 month times 12?
That is correct.
If you have
Okay.
workers who work on oil fields and employer provides housing, do you need documentation on VOE so they are out weeks at a time?
Mm, hmm, I'm not sure. Kendra?
Yeah, typically when, let me make sure I'm off mute. Sorry, y'all. Typically when there's housing income, we would just need to see the contract to see that they've been receiving it and also the continuance to verify if it's something that we can use.
Awesome.
All right, bank statements. This is the most commonly used for self-employment and for stacking, right? We can use either 12 or 24 months of statements, and they can be business or personal or both. And remember when I said the default is to go bank statements, the expense factor here is 50%, the standard expense factor. And remember on the 1099, it was 10%, which is why I always want to ask for that 1099. But standard expense factor, with a CPA letter, we can reduce it to as low as 10%. So an example, if I have 100,000 in income, I'm going to take 50% of that, divide it by 12, and that basically gives me roughly $4,300 a month. So there's no tax returns or transcripts required. And we calculate the income prior to submission. So it gives you some confidence in what your income is going to look like. You'll even, be able to know what deposits that we need to source in most cases. So it gives you a lot of confidence before you send the file in. And this one's very common. Next,
Michelle,
uh-huh.
one other thing on the 1099, can you go over the expense factor? Is it 10%? How does it work between the two W-2 and standard options?
So W-2 to 1099, there is no expense factor. I get 100% of the payout. If it is 1099, then I have a 10% expense factor, which means I can use 90% of the income.
Awesome. And then for some of the stackable income, can you stack asset depletion and business income and rental property income together?
Yes, you can. Yes, you can. And I've got a few examples here in just a few minutes, but that's kind of the big takeaway from today's presentation. There's these products that we're talking about, the different types of income streams. These can be stacked together um, to get you where you need to be. And I've got a few examples coming up here in just a second as well. But yes, the answer is yes.
And on the W-2 to 1099 program, does their contract have to confirm a guaranteed rate of pay? For example, they recently transitioned in the past 3 months. They have 3 months of income receipts, but don't have an official contract guaranteeing their rate of pay. Would we be able to use that income?
So
Kendra, can you? Yeah.
yeah, so typically in that case, the main thing that we're really wanting to see on the offer letter or the employment contract is we want to see what their title is, whether or not they have any required unreimbursed expenses, like Michelle mentioned. And then we also want to see what their rate of pay is going to be. This typically works the absolute best for borrowers that are either salary or full-time and hourly.
Great. And can you explain on this slide for bank statements the 50% expense factor?
Yep. So we apply an expense factor. So let's take their total eligible deposits. So let's call them 100,000. And if my total eligible deposits are 100,000, I'm going to take 50%, which is 50,000, and that's going to be my annual income. And then I'll divide it by 12 to give me my monthly income.
Awesome.
All right, next up, CPA. There's two ways that you can engage a CPA to help with it's either P&L or gross receipts. The CPA letter for gross receipts, we'd need a CPA letter stating the gross receipts, I can't talk, for their most recent year tax return. And just like bank statements, we'll have an expense factor. So we would apply a 50% expense factor. Again, so if it was 100,000 gross receipts, 50% divided by 12, 4,300-ish a month. If they're 100% owner, they do need to be 50% owner in the business. And also we would confirm the year-to-date income with 2 months business bank statements. For P&L, the calculation on income is actually their net income divided by 12 times their ownership, the borrower's ownership percentage. So gross receipts, there's an expense factor. P&L, we use the net income divided by 12.
Can a tax preparer complete a P&L?
Yes, or
Yes.
yes.
And these actually need to be prepared by their CPA or licensed tax preparer.
hmm And we will validate of course, the CPA's credentials as well. Um, and programs like these are another one, just like the IRA that Kendra was talking about earlier. These CPAs, these are good referral source. They'll often refer their clients directly to the loan officers that are offering these programs. So these are definitely conversations you want to have if you have CPAs in your referrals space.
And what is the max LTV on these CPA
Oh,
programs?
thank you. Thank you. Good catch. 80%. We are limited to an 80% LTV on this CPA product.
Do you find CPAs that are willing to do this? Sometimes we have some reluctancy to provide letters.
Um, I haven't run into that. I mean, I've been
I
able to secure letters.
Yeah, I have only run into this issue literally maybe twice in the last 3.5 years. What what I found through my personal experience is once they realize that we're talking about like the borrower's true work-related expenses, not just paper write-off expenses, they're a lot more comfortable providing the letter.
Perfect. And then just to confirm, are we able to stack the assets we reviewed with all these other types of income?
Yes, that's correct.
Awesome. And do we need a CPA letter if we're already hitting them for 50% of the expenses?
No.
Or like on the bank statement, or no, we would not need a CPA letter. The only reason you would need a CPA letter is if they couldn't put their hands on their operating agreement or whatever for ownership percentage, and a CPA could also address that for them. As long as they have their operating agreement and they can, document their ownership percentage in the business, then we shouldn't need a letter from the CPA.
And one thing I like to mention on the CPA gross receipts, basically the CPA just needs to provide what their gross income was. We'll do, as Michelle mentioned, we'll just do the standard 50% expense factor. If the CPA feels like their true expense factor is lower than 50%, then they can absolutely include that in the letter. Obviously, though, if they feel like their expense factor is more than 50%, they can just keep that information to themselves.
Perfect. And when you were talking about the bank statements, you mentioned eligible deposits. What determines if a deposit is eligible or ineligible?
Sure. So, if it's a return, those aren't eligible. If it's not income related, like a payment from the IRS, that we're going to take that out. If it is a transfer from another account, so there's it has to be income, right? And we're usually able to pinpoint those, but if it's not income or if it's transfer from another account, um, we would need that account in order to document the income as well.
And on the bank statement program, what is your reserve requirements?
And the 3 months, 3 months,
This varies depending on the LTV and also
LTV, yeah.
the loan amount. So typically, if the LTV is 85% or below, you're looking at 3 to 6 months. If it's a 90 LTV, you're looking at 6 months or more.
And does that apply also for the 1099 program?
Yes,
Yes.
And what is your minimum FICO for the 1099 program?
620.
Do all of these need 2 years of self-employment?
No, in most cases we can do 1 year. If you're worried about, I mean, if they went from being I don't know. Yes, we can do 1 year.
One thing I like to mention with that too, so they can be employed for a minimum of 12 months as long as they have either experience or education in
Okay,
that same field or line of work. So, for example, I did a loan, I think it was last year now, we had a borrower who was an attorney. He'd been self-employed. He had had his firm for a year. Prior to that, he was in law school. Law school counts as the prior experience, so we were able to do it with him just being self-employed for 1 year.
Awesome.
thanks. Okay, flipper income, not to be confused with, a fix and flip, but for this is really designed for real estate investors who flip properties, right? So to qualify for this, the borrower needs to be at least 25% owner in the projects and must have completed at least 2 flips in the last 12 months. And we'll document this with the Alta statements for the purchase and the sale of the transaction, and then calculate the qualifying income using 25% of the gross profit, right? So I put an example down here. So gross profit times ownership. We'll say they're 100% owner, and 25% of the gross profit, that gives me $45,194 divided by 12. So I pick up $3,766 in monthly income. And I have seen this save a deal, and I actually think I have an example here. These are recent transactions where we were able to stack income and make it work, right? So this one was a $620,000 purchase, an 80% LTV. And this was actually full doc, but their full doc income did not get them to the closing table. They didn't qualify because their DTI was 76%. So they had a nice IRA account. We added that to the income and it brought us down to a 41 DTI and a doable deal, right? And we closed in 28 days. It was easy peasy. And the next one, I think I actually have one. Yeah. This one, it was a 12-month bank statement program. That was the product. It was Sequoia, 80%, actually may have been Rainier, 80% LTV. And we had wage earner income. We had a self-employer borrower with bank statement income. And they also had a few properties that they had flipped the previous year. And so we were able to, and that's actually the exact calculation for the screen that I just showed you. That was the amount of income that we added to, and that you'll notice our DTI here is 46%. Without that 3,700 in additional income, we didn't have a deal. So really thinking outside the box and asking, all those questions, not just do you have a gift, right? Can you get a gift? What other incomes can we do to make it work, right? So that's those are ones that are personal to me that I've done in the past few months. So love the IRA. It's going very love seeing that. As a matter of fact, we closed one today that used only IRA income, and it was so simple. Go ahead. Marketing. If you guys
Oh, we've
haven't been
got
on
some
it,
questions
awesome.
before we jump into marketing.
Right.
What is the max LTV on your IRA program?
So
90.
we can go up to 90.
Awesome. And will stacking work with HELOCs or HELOANs?
Not
No.
today.
Borrower has been a realtor for 10 years. Through 2016 through 2019, she was W-2 as a city employee. She also recently went back to work 6 months ago, same line of work in another city. Would I be able to use the 1099 1 year and the W-2 income together?
So typically when they're working multiple jobs, we like to see at least a 12-month history.
Awesome. If I want to do a loan for myself as a licensed MLO, do I have to put a different MLO on the 1003 or can I be the MLO on the application with the asset depletion program?
That is a good question. So it will need to be done by another MLO. It's fine if they're also at your branch. It just can't be you originating your own loan.
Can you explain how you can stack the rental property income with W-2?
Michelle, do you want to take that one?
I'm not sure I understand the question. I'm sorry.
So in this case, if I'm understanding this correctly, so it would be a W-2 borrower, but they also have rental properties. Am I reading that correctly, Kayla?
I think so.
Okay.
Okay.
So yes, in that case, we can typically stack them. We would just need the lease agreement or the last 12 months of the short-term rental history if the investment properties are STRs. And they can pull that from the platform. So like Airbnb, Verbo, Property Manager, etc. And then yes, we can combine those.
Great. And then can you explain how a 401k can be used in this situation?
So if it's a current employer, it would follow the asset depletion breakdown. So it would be either 70 or 80%, depending on their age. And then we would divide that by 60 months. If it's a 401k from a prior employer, then it would fall under the IRA calculations and it would be either 90 or 100% over 36 months.
Great. Is there an expense factor when using that Airbnb income?
Yes, so typically we'll use 80%.
You mentioned when calculating IRA, it's divided by 36. Is there a reason why it's 36?
We're just able to be a little bit more friendly on that one and give them more qualifying income because the IRA truly is their income, whereas a 401k is subject to the terms of withdrawals.
And then where can we find quick answers to various programs, qualifying with the IRA or parameters for other retirement accounts? Well, I think that's the best thing you can have your AE for. And they are always
Absolutely.
available.
Yes,
Uh,
absolutely. That is definitely what we are here to help with. So you can always reach out to your AE. We'll help you structure it, figure out best way to do it. But we do also have all of our program matrices on our website, which is newfywholesale.com. And you guys are always welcome to kind of poke around on that as well.
Amazing. All right, now let's talk about some marketing. So we
Yes,
have
I was going to
questions
say,
about this too. Um,
yes. So I just want to say, and I'm not saying this just because our marketing team is on it, we have a truly fantastic marketing team. And not only are they constantly coming up with content, flyers, making things pretty for us, but they're also constantly working on white label marketing materials for you guys as well. So these are some examples here that you can use for your own marketing. It doesn't have any NuFi branding or anything like that. These can be found on the website, which is again the newfywholesale.com under our resources tab, and it's under custom marketing. So anytime you have some free time, highly recommend that you just kind of play around and take a look at that. Not only do we have flyers, but we also have social media
Right.
posts that you guys can do. And then we also have marketing kits for pretty much all of our programs. One of my personal favorites, even though it's not a program that we discussed today, is the Cash Out Second Liens. They have made a literally a day by day marketing kit with email templates that you guys can use to market to your database.
Amazing.
Yep. Yeah,
Yes,
there's a calendar in the kits as well with the 30 days of actionable items. It sort of takes the guesswork out of it for you. Um, it's gold. If
Yeah,
I would definitely recommend out. Then there's various different marketing kits out there for you guys on our website. So I would take a look at them.
absolutely.
100%. Yes. Social media posts, video scripts. We have email campaign ideas for you. So these are all crafted by our team, which has experience with the programs, knows what gets people to grab their attention, and are available for edits on Adobe Acrobat, or if you need a Canva link, we can also send that to you. So we are happy to help. All three of these flyers featured here will be sent to you right after this recording, along with the presentation, along with the slides and the recording of this. And we have a bunch more questions. I don't think we're going to get to all of them today because we are at time. But if you have a question here, we will connect you with your AE immediately after this call and make sure your question gets answered. So thank you guys so much for joining us today. Thank you, Kendra and Michelle, for doing an amazing job. We are here to help you at NewFi. And if you have any questions or any things that we can support with, please let us know. Have a great day,
Absolutely.
everyone.
Thanks, guys. Have a good one.